Let me get this out the way right at the top. The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. These are just my opinions. You know, opinions are like elbows. Everybody's got one. And today, oh, what's up, Devin? What's up, Devin? We're gonna talk a little money stuff. Of course, this is serious out here now, y'all. This is getting serious. Like I said in other videos, I put up a whole lot of videos. I will increase my frequency, but it's serious. This is not the time. It's time to get your priorities right on where you need to focus. So I'm just, just kind of imploring everybody to take a little time out, to pay attention to try to understand what's going on with this money situation. What I have posted right now is something that came up today, 11:30 this morning. It says the Treasury is about to flood the market with debt to fund the U.S. $1 trillion deficit, and that is a concern. Aside from the politics of whether that's a concern or not, as a trader, I don't care about that part. I don't care about that part. I only care, and you should primarily care how these things affect you in the immediate. Change is constant in the universe, in the world, in the financial markets too, and how we respond to those changes determine whether we're rich or poor. The change is neither good nor bad. It's our response to it. That's the issue. We live in this construct we live in. We have economic systems economies and that we live in, economic systems that we live in. And those systems, they grow, and at some point in time, they grow too much. They get too fat, and they have to go on a diet, and that's what's going on with this particular economy. That's not a bad thing. That's a great thing if you were gaining wealth as the economy was gaining weight. If you were gaining wealth, then that's a great thing. So I say our, I'm a pro-black, black man. So that's what I mean, our. And I also mean our in the sense of working class folk in capitalism. So I mean our in that sense of being peons, in these economies. We're not rich, we're the fodder. So our in that sense, too, our interest is in learning how to exercise this freedom, this free choice and free will, that we have to make decisions that allow us to benefit from this change. So it's not, you won't find me places arguing about, whether it was good or bad that we came off the gold standard. It's all irrelevant. That is an irrelevant discussion. Okay. Value, money change. I want people to think in terms of value. It's all about chasing value. There's a time when you go to the store, you're participating in trade. You're trading your money, your fiat currency in this case, for some product. The person, so who's winning in that exchange? That's the issue. Which over time, what's going to appreciate more? The money you gave the store or gave to the store, or the product you got in trade? And the people that are cumulatively on the losing side of that, meaning the people that end up giving away the thing that appreciates and receiving in turn the thing that does not, that's who determines who's rich and who's poor, who's powerful and who's weak. Um, and so now there is no one on this on my street over here. There is no one easy answer. It's not like always buy property or always invest in the stock market. There's no always. There's a time to buy gold and property and invest in the stock market. Then there's a time not to do those things. So what I'm trying to share, it's my opinion of how to know when to do those things, when to be on what side of the street or what side of the seesaw. And technical analysis is the study of basically the flow of money, or in the stock market, or it comes down to chart reading, which is showing you the flow of money to determine when those macroeconomic winds change direction, which says, hey, we got to do another thing. We got to invest another way. And so treasuries, now back to this document here. Now, you know what? I'm going to sneak up on it another way. I'm going to sneak up on this. I'm getting to this point. I'm getting there. Stay with me. Y'all see my emoji is that spiral. Okay. I will spiral to the point. Okay. But everything I say along the way is important to understanding the point. Confusion about the point when we get there is proof that you didn't understand something as I spiral to it. All right. Hang in there with me. I'm going to wax a little bit. All right. So we got treasuries. Okay. We got corporations. They make products. We work for them to make those products and provide those services. Corporations get loans from banks, open up new branches, buy raw materials to make the widget. They hire workers to help make the widget. They capitalize off of your productivity so that they can sell the product that you make at a multiple greater than they had to pay you to make the product. That's business. That's the business proposition. And they feel so confident of that business proposition that they go to a bank and they get a loan to hire you, to buy that cubicle, to put your desk, put a computer on it, give you benefits. All that money flows all throughout the economy, all based on that business proposition that I can exploit your labor and you can make more of those widgets and services than it costs me to pay you to make those widgets and services. Okay, so that's business. All right. Now, the stock of that company goes up over time, so you got the stock price appreciation, and we all can buy the stock and participate in the exploitation. All right, that's capitalism. It's progressive exploitation. All right, and the problem is not necessarily. I'm not saying the exploitation is good, but the problem is not to participate in the system. All right, because like I said, it's progressive exploitation, and many times we benefit from it. The mistake is to try to be exempt from it. You cannot be exempt from the process, from the game. The way to assure yourself of losing the game is to attempt to try not to play it. Okay, you got to play to win. You got to understand the game, though. So the lowest person on the totem pole can buy shares in a company that's winning big time. So everybody can win incrementally if they know how to play the game, if they understand the game. And over here, I'm hipping you to game as I see it. All right. So when the economy is growing, gaining weight, as we talked about earlier, on the way to being fat and bloated, okay, and it's buying more of the raw materials like the steel and aluminum that America is fighting China about, because we have a glut. We have a glut of steel, aluminum, oil, every raw material it takes to make stuff you don't need, stuff you purchase with your credit card. We got too many product. So it's time for the machine, the factory, the assembly line that creates all these things that we buy. And we've created too much stuff, and we don't have, and people have bought all of it that they have the resources to buy, or and that they have the appetite for. Okay, so we're just bloated now. But along the way, we were buying stocks of the companies, and we participated in that growth of that getting fat. Okay, now we're sitting at the top. The big money in the world that participated in that growth, that bought the stocks that appreciated, that went from the low left edge of the stock chart to the upper right edge of the stock chart. The people that participated in that growth, and that's all of us have an interest in wanting to participate in that growth. If you've been working a job since 2009 and you've been investing in your retirement account, then you have participated in that growth. You have participated in this progressive system of exploitation we call capitalism. Okay, so that dog bites both ways. We all have a vested interest in participating in this system. Now, what's going on at this point that we're at the upper end of the chart? You want to save your money. You want to keep that growth accumulation. You don't want to give it away. So the mindset, the psychology in the market changes from the appreciation of wealth to the preservation of wealth. So in the beginning, as the prices was moving from the low end of the stock chart to the upper end, you were he says just another reason to buy gold stock now. Well, you know what? We're gonna talk about that. Probably not in this feed, maybe a next one. I'm gonna offer a counter opinion to that. But let me continue with my flow, and we're gonna talk about that in some other videos. I want you to stay tuned to this channel as the next videos are going to be about more specifically about gold. But I'm gonna keep my focus on bonds for this one. And right now I'm being distracted by the comments coming up on the screen. I got to figure out how to work this software to turn that off. Crap, I'll get to it. Well, y'all do y'all thing. Y'all do y'all thing. You know, that's good. Just keep them opinion. We're gonna have a healthy discussion about it. Remember, it's just my opinion. Everybody's got elbows, elbows, and you know what, But the thing is, I can back up my opinion on a chart and make you agree with me. Watch. I'm gonna convert you. Because you're not gonna be able to turn off what you see. You're gonna hear me say stuff here, and then you're gonna watch the whole news flow in the financial markets catch up to what I'm telling you. Okay, because the technical view of things is superior. It is superior. You're going to become technical traders, and you're going to love it so much that you're going to sign up and be on my Patreon for $10 a month. Okay, I can't give this away for less than that now. This is my life's accumulation. I paid a lot to come to this understanding. So anyway, back to the point. When you're sitting at the top of the market, and you want to keep the money you have gained. And if you've been working a job since 2009, you've gained a lot. You have a lot that in need of protecting. At that point in the process, you're concerned with how do you keep what you have. There's no more stock price appreciation left. In fact, is that we've reached a moment in time where the stocks have to, quote unquote, as they say, correct or revert to the mean. Okay, a pullback. Okay, so all that means is you're gonna be losing some money in terms of your appreciation of your stock price, or that balance that made you feel good when you opened up your statement and you saw how fat your retirement account was looking. You've fallen in love with that number. Okay, and you in your mind you've accepted that that's the floor. Well, for the people who sit and do nothing, that number is just going to come and go. They're going to watch it dissipate. Again, I'm not a financial advisor. This is all entertainment purposes. It's just my opinion. get your own financial advisor, you can go to your bank, and a lot of them offer services there. You can talk to your retirement plan administrator. They give you people you can call who manage the money in your retirement account, and they give you free advice. And so definitely take advantage of all the free advice. Avoid the rush. Make a plan to call them this week. I'm going to say this. It is an absolute emergency that you call them this week. There's nothing in your financial life that's more important than getting information right now. It is an emergency that you get information this week. Okay, I can't be more emphatic about that. This is different. Nobody, in the opinion of most technical traders, the decline that we're looking at, or that we're facing, or possibly facing, I feel pretty certain of it. But the decline that we are facing, that no one is saying that it's not coming. We debate about when it's coming or if it's here now, but I haven't heard any debate that it's not coming. But in the opinion of technical traders, this decline will be greater than anything anyone alive has experienced. So no one was an adult. No one alive now was an adult during the, quote, Great Depression decline in 1929. No one was around for that. There has been no decline since then on the scale of that decline. Okay. For subscribers of my channel and subscribers of Elliott Wave Theory, you know what this is, and you know why, and you got an idea how steep it can go. Okay. This is not anything to play around with. If you're 50 years and older, this gets down to whether you're going to retire or not. Okay. All right. And if you're young, it can determine if you're going to work all your life until you get to be 60. If you had any notion of early retirement, getting some education right now, this one move can set up your entire generation and your lineage. This is the time to do the one smart financial thing that can set your whole life up. Like I said, and your grandchildren's. No, back to the point. I drift, that spiral, I get lost. When prices are at the top of a long run, and there's no more, and the economic cycle is at the top of its growth, there's no more growth. So what big money does is look for another place to grow. So they look one inside of the stock market, other places that haven't grown as much, and that's like your consumer staples sector. I'll be talking about that in future video. I'll be pointing out things. Sometimes they'll go, in this case, into a bear market fund. I call those Vegas plays. I'm not against them, but you got to know what you're doing, because I will show you examples of how they don't always work. How I personally lost some money in one that does not go. It's supposed to go up when the thing is pegged to go down. I can show you one that didn't do that, and I can offer at least my opinion about why it didn't work as advertised. And I fear that some of these bear market funds are not going to work as advertised. I fear that the same thing is going to happen again. And they've covered themselves. These funds have covered themselves legally because they describe it, and they kind of warn about it in their prospectus. So, it's like they covered themselves when it doesn't work. When we buy it thinking this bear market fund is going to go up, from what I can see on the charts, yeah, they're going to go up. They're going to have a nice pop, but I don't think they're going to track and continue to go up. There's a good chance they may not. So even if you're in a bear market fund, and that's one thing that people are going to do. In fact, I'm even going to do that. Okay, but I watch the stuff all the time. So this is not like set and forget it time. Anyway, so in addition to going to elsewhere in the stock market, that's where big money is going to look. We're going to go elsewhere in the stock market. Another thing, what big money is going to do is they're going to go from being a stock investor to becoming a bank. So how do you become the bank? You become the bank by loaning money. When you loan money to a company, that's a corporate bond. Corporate bond is a bond is you loaning money. So you loan the money and they pay you interest, as opposed to you going to the bank getting a loan and you paying them interest. See, the tables flip. So a corporate bond is you making a loan to a corporation. A municipal bond is you making a loan to the state. A treasury bond bill note is you making a loan to the federal government. So what big money does when stocks have run up high and it's gotten as fat as they're likely to get, and the prospect of stock price appreciation is severely diminished, big money will go from stocks to bonds. They'll go from being the stock investor to being the bond investor. They'll take that money and basically loan it right back to the government and to governments, what they ask, state and federal governments and corporations. Say they'll look for high quality corporations. They'll look for state governments that's likely to pay them their money back. But in the case of state and federal governments, it's considered a very low risk or no risk investment to your principal, at least, because the state government and the federal government, they will raise taxes on the people if necessary to make sure you get your money back. So people that have made a lot of money on a run up in stock prices, they flip and they become bond investors. That's what a lot of big money does. That's what a lot of whales are going to do. Because the government, has a large appetite. If you got multiple millions, the government can absorb that loan easily. Sure, you can loan us millions. And so what governments will do is take those low interest loans, especially at this point in time, and make a loan with you, and they'll build bridges and they'll help make the payroll to keep everybody paid, to keep government working. And with corporations, they'll use that money for the same thing. They're trying to hold on and not go bankrupt as the economy is slowing down and they're selling less widgets. And so the bond investors are looking at the assets of the company. They're trying to make sure that the assets of the company is worth more than the debt that the company is taking on in these loans. And as long as the assets in the open market are worth more than the debt, they'll make the loan, because they're like, well, we'll auction off the company or sell the company, and bondholders get paid first. They get paid first. So if a company goes out of business, they'll pick over the remains, and the bondholders will own the company. And Warren Buffett does that. He'll find a company in a good sector. Maybe it's got good employees, everything is good, but hey, the economy is just turning negative, and the company doesn't have the cash to survive the slowdown in business. So you'll buy some bonds, and when the company can't make it anymore, going out of business, step in and buy it dirt cheap. He keeps all the good employees. That way he doesn't have to go out and find excellent workers anymore, and life just keeps going on. And he ended up buying a company on pennies on the dollar. So there's a whole market out there in this bond world. People usually are ignoring it because the stock. I put this whole thing about treasury bonds and notes and different types. I put that at the top of the chat list if y'all want to read that. Also, I put at the top of the chat list this article here. It's a pretty good article. It talks about how the federal government is going to raise money for debt, and they're talking about creating a 100-year bond. Right now, the longest bond we got is a 30-year bond. They talk about a 100-year bond. So that the federal government is creating, or they're discussing. Let me not say they're creating. They're gauging the interest. Let me see. Let's see what this says. There may be some an anticipated surge of U.S. borrowing in the global debt markets in the second half of this year is starting to create concern as the Treasury is expected to ramp up its issuance of bills, notes, and bonds to fund a soaring $1 trillion budget deficit. So we're going to be loaning the government money to get by this deficit. That's why I'm not even worrying about, that I don't even get in that deficit talk, because that money from the stock market, a lot of it is going to find its way there at low interest rate. They'll work it out. The U.S. government's budget gap has widened 27% as compared with the first 10 months. I'm just trying to get to the good stuff. Okay, last month, the U.S. Treasury laid out its plan to borrow $850 billion. I'm trying to get to the 100-year thing. Oh crap! I don't want to look for it, but it's in here. It's in here. I want to stay on point. Y'all can look it over, but that's the high concept. This article just came out today. You're going to hear more about it, but just know that in the big picture, it's the government taking advantage of the fact that there's a lot of money, smart money in the stock market that wants a safe place to invest where their principal can be protected. It's a way for them not to lose that money they made as the stock market was running up. So that money is going to come over to the bond market. Now, the bond market is pretty complex. Any of you economists out there, y'all can, jump on and, maybe in another video. I'll see how I feel if I'm open this up. But I will definitely cede the floor to you guys to explain this stuff. But the bond market is two things that you're concerned about with bonds. It's the interest rate on the bond and the face value of the bond. Face value would be like $10,000 or $100,000 or whatever it is, okay? And the interest rate is what the government will pay you for loaning them the money. And so at the end of the maturity of the bond, you get that principal back, that $100,000 and a little bit more. But along the way, the government pays you interest. So if you are, let's say, Oprah Winfrey, and you want a safe place to put your money, you'll loan money to the government, and the government will cut you interest rate payments. So you know that your $1 billion is going to be safe. And if you can't live off of a couple percent of $1 billion, then you really got a serious problem. Okay, and something's wrong with your life. So a lot of the uber rich, they live off of, in the stock world, they live off the dividend payment. When the stock price is appreciating, they'll get a dividend payment from the company. And so they don't really have to touch their stock. And so they're getting a dividend payment and they live off of that. And then when the stock market is finished rising and they want a safe place to put their money, they buy these bonds of one sort or another, and they get the interest rate payment and they live off of that. And so that's how you get, if they can keep their living expenses low, they can, once they get rich, that's how you stay rich for multiple generations, is you condition your life to live at the money that you get from the dividend, or the money you get in the case of buying dividend paying stocks, and the money you get from the interest if you're buying treasury notes, bills, and whatever, treasury products, let me just put it that way. So the fact that the government is not a coincidence. See, and as a technical trader, we know there's no such thing as a coincidence. It's not a coincidence that the government today says, okay, we're issuing, we want to gauge the interest in the marketplace for the appetite or interest in the marketplace for a 100-year bond. Are y'all interested in that? Okay, so the answer is likely to come back yes. Okay, so bonds are always being purchased, and there's a primary market. That's where you buy bonds directly from the government. Then there's a secondary market where older bonds are sold. Okay. Let me see. What am I trying to show? So the older bonds that are out there, they got, they're in the market, so they got traded, and the value kept going higher and higher, higher up, the older bonds in the market. And this is like the secondary market. And so that's the bond bubble. that people are talking about, all these old bonds out there. All right. So then you got the interest rate on the bond. So as the face value of the bond goes higher, the interest, I'm sorry, the face value, as the bond trades above the face value in the secondary market, the interest rate on the bond goes down. So you can get a higher, uh, you can get a higher, how is this? How am I saying? The value of the bond basically trades opposite to the interest rate. So you can get one or the other, but you can't get both. And so what made me do this video is everything is, of course, always chart based with me. Is okay, I'm sorry. Let me just go here. This is a video. This is like that appreciation of the market value, market value of the bond. And this is an ETF called the TLT. Okay, and you will see this talked about in the news. This is the bubble. Okay. And then you got, let me see what it looks like on the daily. Okay. What's troubling is yesterday, it made a lower low. Okay. For it to make a lower low at this critical point where it looks like the S&P is really turning around, that's kind of suspicious. Okay. That got my attention. All right. Okay. And the long run up in the stock market since 2009, and the rise in bonds in that secondary market. This is the 10-year, the 20-year yield. Basically, is no. This is a short of. It's the inverse of this. Okay. So this company that sells this particular 20-year bond, they also sell an inverse version. Now, what we have here is the interest rate on that bond here. So remember I said you can get the appreciation of the bond, or you can get the interest rate. You can't get both. Okay. So this is what that appreciation looks like. And this lower low signals or suggests that we may have come to the end of this rise. Okay. And this interest rate here is a decline since this is the bond yield of the interest rate from 1981. We got a sideways movement right here that's been going sideways since. My eyes are going bad. 2002. I'm gonna zoom in to show you something. This much for anybody that's like technical into technical analysis at all. So this is very key. This is what we call what I think looks like in the making a reverse head and shoulders. Okay, this would be the left shoulder, and the low was in July of 2016. Okay. And so you see up at the top here, the low is where I'm looking in the information section. See, the low says 1442 is the low. Now, it's not the absolute low. That's the left shoulder. The absolute low is here. 1336. Now we're over here today. This is where we are this week, as of yesterday. 1596. I think this decline is over. I think it ended yesterday. Let me go down to the weekly. Again, got a little pop. Not quite a higher high on this, but we're going to get there. So this is something to watch. This is what has a lot of people confused with it when the market was dropping. Why didn't this yield start to rise? Well, it's starting to perform now. It's right on this resistance. And this week coming up, if you see the stock market fall faster. If it falls faster than it was, like that 800 points, if we start going back to that 800 point level decline or worse, this is going to be why. This is going to something that you come and look at, and you see what's going on here. You go, okay, this is money going into this bond, uh, investing in this bond yield. Okay, so the technical pattern is called a reverse head and shoulders. This would be considered the left shoulder. This would be the head. This would be the right shoulder. So think of it as somebody standing upside down with on their head right here, their left shoulder and their right shoulder. The head is the lowest point, and usually the shoulders slope in the direction of the new trend. So this left shoulder is usually going to be lower than the right for in an uptrend. We're not. It's not confirmed right now, but yesterday's movement, it looks suspicious. On the brain trust, about 3 or 4 weeks ago, I started telling people, pointing out suspicious activity in the options market as it relates to the S&P 500. The number of puts in the options market, bets against the market, are called puts. Bets in favor or bullish bets are called calls, and the put call ratio has gotten real extreme. It was like 3 and 4, anything over 1, like 1 to 1. It's usually a balance. You expect the puts and calls to be about the same, or maybe slightly favored and weighted in favor of the calls. And an optimistic market, a bullish market, you're going to be, that optimism is going to show in the put call ratio. You're going to see bets for the market to validate that uptrend. But what a lot of big money, what they'll do, they'll go in the options market and short it that way. So you don't really see it on the S&P 500 chart until you go look in the options market. You go, wait a minute, these people are betting against the market. And when you take a short position, say in the stock market, even in the stock market, it begins with a purchase of the stock. So the broker will purchase the stock that you're borrowing. When you're shorting a stock, you're borrowing that stock. And you're going to give the stock back later to the broker, and the depreciation of the value of that stock is what you put in your pocket. I know it's convoluted, but that's the concept. But technical analysis, we watch that activity to see the real intention, the real sentiment of big money. They try to hide it by going to the options market and short the market there by buying puts. And so that put ratio, the number of puts, had severely outweighed the number of calls. And that to me said, I'm not going to be in a state of confusion about whether we have real optimism here or not. So that tipped off the decline, and sure enough, the prices started to come down. So it was right on the money. And so I'm not gonna go too much further than that. I'm gonna do a separate video about the S&P 500 and how where to some places to invest in that. But I wanted to just tell you about this interest rate and this I'm sorry, not the interest rate, the bond yields, how it looks to me that it's setting up that money is starting to flow this way, and the federal government is gauging interest in on behalf of big money and see if they're interested in basically loaning the government money with a very, very, very long term payoff of 50 and 100 years. Okay. So that's setting up other things, like the dollar is getting stronger right now, and the other currencies around the world are going to get tremendously weak. And those people with lots of money in other countries, in order to preserve their purchasing power, they don't want to keep their money in their currency, which is losing purchasing power. They would rather move their money or convert their money into a currency that's going to be appreciating, because they don't want to get poorer or as their currency is getting weaker, you want to get richer as your currency. You rather get richer than poorer. So if you can't do it in your own currency, you'll do it in another one. Okay, that's like when you travel to these other countries. Brothers like to go to the DR or Africa or different places, and they live like they're rich. That's because you just changed into another currency. Okay, you're in a currency that's stronger than the one in the country that you're in. So for that, and so because your currency is dominant to theirs, you are rich there. So as long as you stay there, you're gonna be rich. You'll come, you don't until you come back home. There's a reason that we in America, a lot of working class folk, there's a reason that we travel more to say, Africa, Dominican Republic, and those kinds of places, and we don't go to Europe as much because some of those currencies are stronger than the US dollar. So when we go there, we feel poor because everything costs more than it does here. And then when we go to other places, things cost less than they do here. But that's in a state of change right now as the dollar is gaining strength, and that's also why a lot of Europe, they don't like that their currency is losing value. And that's also why historically they travel to America a lot because they feel richer when they come here because their currency is stronger than the dollar. So everybody wants to feel like a king, so they go someplace where their money is stronger. Well, as this dollar appreciation continues. I'm gonna go on a limb. I'm the only one saying this. This interest rate's going up. This interest rate is going up. The sheer demand in the market is gonna make it go up. The demand for the dollar is gonna make it go up. The demand for this paper, for the bonds of all sorts, especially the treasury bonds. The demand for bonds, people making loans to government, the demand or then the desire for the government to get that money, they're gonna have to make it attractive, so the interest rate would help, so you're gonna the high interest rate, especially on short-term paper, that's attractive. The government's telling you that we're going to give you a high interest rate. You loan us money for short term is anything less than a year. That's a 1 month, 3 months, 6 months, a year. Government, is going to start giving you good interest rate. If they just want to hold your money for a year, and you just coming out the stock market where you fat and happy. That is going to that demand there, as well as the demand on for U.S. dollars by other currencies around the world. I just can't see how that doesn't create an environment for the interest rate going higher because the market can withstand it. I mean, aren't money lenders and banks in the business of making money off of loaning money? If you can't raise the interest rate and the time when what you have is in demand, when can you raise it? I understand that the higher interest rate would be disastrous for the economy. Watch this. So what? It's still gonna go up. They still gonna raise the interest rate, and that's gonna really put a halt to this economic activity. It's gonna bring, it's gonna really do devastation to the real estate market. You're gonna see that. You're gonna see that. That's gonna come to a halt real fast. People out there, if you're trying to sell some property, don't look again. Everybody's got elbows. This is just my opinion, but this is not the time to be fighting for the last penny. If you can get you a good, make a good deal, run with it, because when that interest rate goes up, it's going to be that much more difficult for people to get loans to buy your property. But that's enough rambling on that. I'm gonna check the chat right now, and let me see. Stop the screen share. Let's see what I got here. Let me see who's riding with me today. Let me see that. Let me start scrolling to the top here and see who I got riding with me. Devin Diggins, of course. Rael, what's up? What's up? Okay. Oh man, it's just that's all I got active in the chat, but that's all right. That's all right. The 80-20 rule applies here too. It's not gonna be. This is not for the many. This is for the. This is for the few. This is for the few. Well, you're right, Devin. This is our red alert. If Devin and Rael, if either of y'all are still here, hit me a one. Give me a one in the chat. If you still riding, if you still out there listening. And Rael says, I tell people all the time, just because you recognize the matrix doesn't mean you don't have to participate in it. That's right. You still got to play the game. That's right. There you go. What's up, Faber? Okay, great, cool. You're right. Yeah, yeah. Because we talk about all that red pill and all of that. Look, once you realize that we live in a construct, you go deeper in it. We got to have a construct. You got millions and millions of people. How do you get people to buy into a common view so you can have peace in this construct we call civilization? Even the jungle is a construct. I mean, you got rules in the jungle. you know, we just got different rules in this construct. So the whole thing is you want to, as we say, self-actualize to the point where you can make the rules. So that if you're going, since we have to live in a construct, we want to make sure that we're the one creating it. That's the issue. Are you living in someone else's construct? You know, So that's it for me. But I don't want to go too far down that line. But yeah, we got to pay attention to what's going on. Try to get that knowledge right now, and this is the time to pay attention to these charts. So I'm gonna try to do something every weekend, if nothing else, because things have kind of slowed down on the weekend. It gives people a chance to pull up some charts and reflect. You know, but you will hear more about bond yields, what's happening in the bond markets, and now that I've said all of this, I'm hoping that you just try to listen to it for a couple of minutes and just see what's going on. If all you can understand is whether it's becoming more attractive for people to buy it now as opposed to before. That's the change I want you. And we're talking the bond yield. That's the one I want you to what I want you to think about. And that symbol that they're probably going to be talking about is I get them confused. It's the TBT. Yeah, TB. Tom Brady touchdown. Tom Brady touchdown. The TBT. Next time I'll use a cowboy, a cowboy analogy, you know. But I'm gonna shut this down. I'm gonna come back later because I gotta talk about. I don't know which I'm gonna do next. Either it's gonna be S&P 500, and basically it's gonna be less ranting and more about just where the money is going. So you can know what to invest in. But like I said, on this one, you got the TBT ETF, which is going to be a destination for a lot of this money. And you have there's some mutual funds out there that invest in it as well. And this bond yield ETF and even the mutual funds, they've been falling for a long time. We talking, I mean, if you look at the chart, it's going to look horrible. It's going to be like, why would you want to invest in it? But there's an exception to every rule, and we're in one of those exceptional times where some of those bond yield funds are going to look interesting. You know, and so like I said, this TBT is going to be one. You can I think I do want to show something really really just quickly if it shows it here. I don't think it. Let me see. I'm just looking at the chart. It kinda. Let me I guess I'll show it real quick. Let's see. Um, so yeah, we had a night. This is back in when the market dropped 2007, 2008 or whatever. This thing had a nice run. And so a lot of people, hid out in this. and made some money. This is like, again, this is like a bond yield fund going from 100, and let's see, the low here was 144 to 239. So that's a significant gain for a bond. So a lot of money is going to look to hide out and catch one of these pops like this in the bond yield section, not the differentiating it from you know, this one. Okay, so there's an inverse of it. Money's going to go the other way. Okay, or you'll see it on, like I said, the 10-year to the treasury note. You'll see this start to rise. Okay, so you're going to have a lot of people invest in that. And so that's really primarily what I'm trying to communicate here. Because again, on the technical channel, we don't debate theory. We look at what money does and we adjust to it. You know. What's up, Charles? What's up, Charles? What's happening, brothers? You still on the road? Where you on the road right now, or you on, or just a weekend for you? You know. So, well, I'm gonna go ahead and sign out. Like I said, I should be back up. I don't even think it's gonna be a half hour. Uh, it might be 15 minutes, might be 10 minutes. I'm going to try to knock these out so I can enjoy my weekend. You know, I have to watch my Cowboys tonight. I'm debating on doing something completely left, creating a new channel, you know, where I can get into the sports. I am a football fanatic, like y'all wouldn't believe. And I'm a really, you know, I usually ghost, especially on Sundays during the football season. Y'all don't see me nowhere around these streets, man. I am a football fanatic, a Cowboys fanatic, but I would say an NFL. I'm a fan of the sport itself more than I am a Cowboys fan. But if I had to pick one team, I've always been a Cowboys fan. So I'm thinking about kicking that off in you know, a channel pretty soon, talking about that, you know. But that's all I got. See y'all soon.